Right, good morning, everybody. Hello and welcome to today's podcast. It's Monday, the 25th of September, 2023. My name is Adrian Boothie. I'm the head of trading here at Trendsignal, and as ever, I'm joined by Jerry Miller, managing director at Trendsignal. Hi, Jerry.
Hi there, morning everyone.
So today we're going to take a look at what's been happening since last week. We're going to set ourselves up for the week ahead with any important announcements and what to be really thinking about when it comes to trading the Forex index and commodity markets. Really, Jerry, the backdrop last week, pretty central bank heavy last week. Some interesting news to go through. So why don't we get through that now, get straight in the deep end. What do we know? What have we seen from last week and what were the reactions?
Well, as you said, a deluge of central bank meetings, not just the Federal Reserve, which is the world's most important central bank, and that's the central bank in the United States. Their rate-setting committee met to deliberate on interest rates, but we also had the Bank of England, our own monetary policy committee, also deciding, and we had the Swiss National Bank and the Japanese bank, the Bank of Japan. And the previous week, if you recall, so not last week, the one before last week, we had the European Central Bank. So it's all happened in a reasonably short space of time, and it tends to happen like that. But we describe these policy meetings as monthly, but the central banks meet 8 times a year. So clearly there are 4 months when they don't meet, but anyway, that's semantics in a way, but it's just unusual, Adrian, to have had so many the way we have had in the last week. So what happened? Well, the Federal Reserve, as we were looking at in the podcast last week, was expected to keep rates unchanged. There was, by the time we got to the day before, I think if you go to the FedWatch tool, Adrian, although it's now not relevant, but this time last week, we were looking at it, the probability of no change in rates was 99%.
Yeah.
So put it this way, had they done something, had they actually changed rates, that would have caused the markets to absolutely shank. That's the funny thing is, in fact, they weren't that happy. So what happened last week, the S&P came off quite sharply, bond prices came off quite sharply. Excuse me, that's the yield going up. So it costs more to borrow money if you're the US Treasury because of the effects of inflation and concerns about that. And basically, they kept rates unchanged, but then they delivered what, I know you don't like me using this term, Adrian, but a hawkish guidance. So what they basically said was that they are likely to raise rates again before the end of the year. Now, that's not something that the market thinks, and you only have to look at the screen there, Adrian. It's 25.5% probability of a hike on the 1st of November. And I think on the 13th of December, the odds go up to about 40%.
Yeah.
So, yeah, 40.7%, which is not a shoe-in, is it? So
No.
there is this split between what the market thinks will happen and what the Federal Reserve committee members think will happen. So they've said they're likely to raise rates again. We, the market, don't think they will.
So here's a question then, because we do these sessions every week, and we always talk about the what the market's pricing in, and there was definitely a misalignment a few months ago, wasn't there? The markets were definitely pricing in a lot more less interest rate action than actually the Fed was sort of discussing. So who tends to be a bit more right here, do you think?
Well, you do get convergence, and sometimes the markets are right, sometimes the Federal Reserve is right, but the Federal Reserve can only deliberate on what's in front of them. But remember, the markets are all to do with anticipating what might happen. That's not the job of the Federal. Well, it sort of is, but it isn't. But the Federal Reserve have to deal with the data that they've seen, and they see the fact that inflation is not coming down as quickly as one would expect. And so they deliver these hawkish guidance comments. So hawkish meaning they're more likely to raise rates than not. And I think it surprised the market. They basically said, they're going to raise rates again, number one. Number two, they're going to keep the rates higher for longer. What does that mean? Well, if you remember back in the spring, we were factoring in 2 rate cuts before the end of the year and more rate cuts next year. Well, there's none of that. The markets are now having to take on board the fact that these interest rates that we've got that have been delivered by the Federal Reserve are going to stay higher for longer.
So, and really that's led to, as you said, the big sort of sell-off from Wednesday last week. We had a short signal in play already, but the market then carried on down and quite aggressively into sort of Wednesday and Thursday, wasn't it, Jerry? So, I mean, pretty significant falls actually. And September's one of the weakest months of the year, isn't it? If we go back sort of 20 or 30 years, it's historically a challenging month for the bulls. Any reason why that would be?
Difficult to know. Sometimes there are corporate tax payment dates. People are away on holiday. They get back and they're confronted with the reality that's going on. Difficult to know, but you're right. Statistically, September is the worst month of the year. So
it's
anyway,
how you have these seasonal factors, don't you? Like sell in May and go away, and then September being weak, and you have the Christmas week rally and things like that. These things sort of repeat in some strange way. But anyway, you carry on.
Yeah, well, if you remember, we had a very strong first half of the year with the Nasdaq posting extraordinary gains of sort of 39%. So it's also likely then that we are going to get a bit of backing and filling as investors take profits and then get a little more critical of what's going on. And that's really what happened last week. The Fed also said that they were as I said, going to keep interest rates higher for longer. And I think it implies that the Fed are more concerned about inflation than the market had perceived. And I think there is going to be that little bit of a battle. Doesn't mean the Fed are going to be right, because inflation data could continue to fall, in which case the Fed may turn around and say, well, okay, because of the data we've now seen, we're not going to raise rates again this year. But that's trying to delve into the future.
Yeah. And what of the UK, Jerry? And what did we see there?
Well, that was really interesting. If you put up the Forex calendar again and we have a look at that CPI data that came out a day before, you can see that we were expecting a figure of around 7% for the headline. We're expecting the core inflation, which is the one that excludes the food and energy, the energy cost, the oil and gas that had really played havoc with inflation over the last year and a half, especially since the invasion of Ukraine by Russia. But guess what? It came in weaker than expected. And the weird thing is, there was an article on the BBC website the day before saying that, publishing a report by the OECD that said that the UK would have the worst inflation rate out of the G7 in the next year. And whilst one swallow doesn't make a summer and all that sort of stuff, but it's just interesting the way that a lot of institutions like the OECD, IMF, even our OBR, they tend to, I guess bad news sells, Adrian. I don't know. But, when I look at the OECD back at the beginning of the year, that's the organization, or even towards the end of last year, I can't remember the exact date, but it basically said that the UK was going to have the worst performance of any G7 economy. Well, after the revisions by the ONS, the Office of National Statistics, we're in the middle of the pack. No one's made a big headline about that. No one said, oh, we're not the sick man of the G7 anymore. And it is a little bit frustrating because it's just unbalanced, that's all. Anyway, good inflation data. Immediately that data came out, immediately the market slashed their forecast of a rate increase the following day from the MPC, because if inflation's under control, why raise rates? And it is a big dilemma for banks because they're all trying to work out, how much further pressure do they apply to interest rates to tame inflation when the effects of these interest rate rises, they take anything up to 15 to 18 months to take effect. So it's a tough old business being a central banker at the moment.
Yeah, and if they get it wrong, if they raise rates too aggressively, too quickly, then of course it could end up be sort of overshooting in many ways and create too much of a problem the other way. And that's really
correct.
It's
Correct. Yeah, that is the problem. That is the problem. And I think the reaction was, it was a 50-50 call in the end whether whether the Bank of England and the MPC would raise rates or not. It was about a 70% probability going into the inflation data, but that had really subsided. And to have got an unchanged rate, I listened to the radio this morning, and Radio 4 speaking to some analysts who were saying the reason why sterling is falling is because we've had some pretty bad economic data recently. Sure, we had a GDP reading for July that wasn't brilliant, but I mean, that'll be offset probably by August. But the main driver, the reason why sterling is hitting a 6-month low, I mean, we haven't been down here since, I don't know, sometime in March the 20-something, anyway, 24th of March, I think it was. The reason why we're down is all to do with interest rate differentials. Well, why is it so low? A lot of hedge funds, Adrian, they were all heavily long sterling, expecting the Bank of England to raise rates to 6.25%, 6.5% at some stage next year. Well, that ain't going to happen. So you're probably getting a bit of an overshoot on the downside as hedge funds rush to close out their long positions. It's a bit like in the gilt market. A lot of hedge funds had shorted the gilt market in anticipation of the gilt market falling out of bed with inflation remaining really high. It's not happened. It's not happened.
Okay, so putting it nice and simply, people are just putting their money elsewhere into other currencies where it might seem to be maybe safer, maybe better rate of return than
you're right. You're right. Does it justify the move
in the pound? Yeah.
Yeah, but does it just move from 131 back in July? Like most things, when you've got a pendulum, the midpoint being the where market should be, but markets always overshoot one way and overshoot the other way, and that's what makes them fun.
Yeah.
Great to
Well,
trade.
it's that's exactly right, Joe. It's that creates the opportunity for us. And I always find myself in these podcasts who think it ends up being some sort of economics podcast, but it is these topics that create the movement in this market. Because if there was no news, then there'd be nothing to react to. There'd be no reason for pension funds, hedge funds, traders to adjust their portfolio. And to be honest, it'd be the most boring thing in the world. So it is this that stimulates movement. We don't have to understand everything about the economic market. We just have to understand that things are happening and we have to adjust our risk accordingly. So, for example, last week with central banks, the UK and the US, we just had to be mindful of our holdings and our risk in those areas. Basically, what we should be aware, though, is that it's likely to stimulate change, and that can only be a good thing. Good. Okay. Anything else to discuss on this side, or should we start to think about what's coming up this coming week?
Well, there were two other central bank meetings, but they also surprised in other ways. So the weird thing is the FOMC kept rates unchanged. The Bank of England kept rates unchanged. The Swiss National Bank kept rates unchanged, which surprised the markets. And the Bank of Japan did nothing, even less than it normally does, which surprised the markets. So central banks are definitely in a bit of a pause mode at the moment.
So one thing that I did note, and I think if I put in here, the votes in the UK was 4 for a hike and then 5 for no change, basically.
Yeah.
One of those was Andrew Bailey, the governor of the Bank of England. So what does that mean? What can we take out? I mean, his vote's no more important than anybody else's, but is there, in terms of, there are 9 votes, they're not weighted in any way, but is there anything that we can glean from the fact that he was unchanged, whereas others were not?
Well, he was on record the week before as saying that he was would not be in favour of a further hike at the moment, along with Hugh Pill, the economist on the committee as well. So we knew that which members, or at least 2 members, were going to vote unchanged. But no, typically, if there is going to be a balance, because there are 9 members, if it's 4-4, obviously it's going to be no decision. So obviously they have an uneven number, and in the event of a 4-4 vote, obviously Bailey's vote sways it. So there's not much relevance to it apart from the fact that it was a close call, but we thought it was going to be a 50-50 call coming into the number, and it turned out that way.
Yeah. Okay. Excellent. Thank you. Well, look, why don't we just have a quick look at what don't we know yet? So there's going to be a few events this coming week. It's certainly not the number of announcements or the importance of the announcements of last week, but what are the 2 or 3 sort of headlines that we should be thinking about as traders, Jerry?
Okay, I'd say the CPI flash estimates coming out of the Eurozone on Friday. That'd be quite interesting. Because the one bank that did raise rates recently was the European Central Bank, not last week, the week before that. But I think traders are speculating that we're also reaching the end of the tightening cycle there. I mean, it's not clear that that's the case in the US or the UK, but it's possible that it will happen in the Eurozone because Germany, the Eurozone's largest economy, is in a right old pickle. And actually, we've got that inflation reading out the day before as well. And I just think, again, it's the dilemma. It's not the job of central banks to encourage economic growth or discourage economic growth. Their job is simply to maintain price stability. And there isn't stability at the moment because inflation went tearing up and now has come sharply lower. But you'll know that oil is above $90, and God knows, in a couple of weeks' time, it might be above $100. I don't know. In which case, all bets would be off again. So we can only react to what happens. We're not in control of it, and neither are central banks. Their job is just to smooth things over. It's not to, provide a soft landing or a hard landing for the economy. That has an effect, but it's not what they're after.
Yeah. Okay. And I know that otherwise there's a few important things, certainly perhaps less important from a swing trading perspective, but certainly fairly important from a day trading perspective. 3 o'clock on Tuesday, we've got the consumer confidence number, bit of a leading indicator, but it's likely to have some impact on the market. So if you are going to be day trading, do certainly be aware. So day trading, so what that means is being in and out of the markets within the same day, basically, often maybe within 10 or 20 minutes, in which case news announcements can be quite important. You shouldn't really be looking to trade over those announcements as a day trader or an intraday trader, but you can look to trade the ripples that take place after the announcements come through, and that can make for much more interesting, more volatile, more opportune markets. So think about that one. 3 o'clock on Tuesday. We've also got I think that's mostly it, to be fair. That's the main item for this coming week. Okay, that's pretty much it then, I think, Jerry. So thank you for that today. Hopefully everyone's found that really useful. In terms of the impact on the markets, what are we trading at the moment? It really is the indices that are having a lot of the movement. And one of the things that we're finding is a lot of the dollar markets, like the pound, really in sort of that free fall. So not huge amounts of action happening there. I say action, certainly plenty of price movement, but not in terms of trading opportunities that we're getting into. The indices, by contrast, they're giving us plenty of trading opportunity. FTSE remaining very, very strong. And then you've got those US indices having a big fall. Even the likes of the DAX, you've got the DAX here at a really interesting level right now. It seems to, if it can hold below these levels, it's taken out support levels from July, taken out the lows there from August. We held on that on Friday. We held on it first thing this morning, but prices have very much come off today. We're down about 60 or 70 on the day now on the DAX, which is great for our short position right now. The next level of support down to that sort of 15,200 level. It'll be interesting to see where we go with that over the coming week or so, as to will these downtrends continue, or will we start to find some buyers down at these sorts of levels. But certainly for now, we remain short the DAX, which is actually our only open position right now, which is relatively unusual, but there we are. So I'm going to call it an end to the podcast there. Hopefully you'll have a wonderful week's trading, wonderful and very profitable week's trading, and we'll be back with you same time, same place next week. Bye for now.